Hola mi gente and welcome back to the channel. This is Sean and this is We Are Investing, a channel that is dedicated in investing and personal finance. On today's video, we are going to be discussing why there is a lot of froth right now in the market, meaning that we could see a pullback anytime now because some things that are happening in the market are signaling that it is very frothy, it is very toppy, and it's about to fall down. The things I'm going to be discussing on today's video are telltale signs that we are toppy in the market and we're due for a pullback. It does not mean that we're going to get a pullback today, tomorrow, this week, or even this month. It just means that we are at high valuations and there is a lot of people capitalizing on that right now in the stock market, meaning that they know that right now it's the best time to try to collect money from this market because it is very toppy. Now, as you may know, a bull market can continue for longer than you expect, and it's not good to take money out of the market trying to time it. As Warren Buffett says, time in the market beats timing the market. And that is because there are huge opportunity costs with trying to time the market. You could take your money out of the market and the bull run can continue for another 20% before you see a 10% correction. If you then re-enter at that 10% correction, well, you lost 10% in gains because the market moved 20% just to pull back 10. In addition to that, you might get impatient. You might take your money out of the market. It can continue to go up and you say the hell with it. You put your money back in and then it just tanks. So it's a very dangerous game to try to time the market. However, there are things you can do to help yourself and prepare yourself for a potential pullback. Some of those things would include trying to keep some cash reserves so you can buy the dip. Another thing would be to get out of some short-term trades that you're not really bullish in for the long term and you wouldn't buy the dip if the stock was to fall. In addition to that, when you're looking for new stocks, make sure that you take a look at the valuation and you try to find stocks that are undervalued because there are still deals out there in the market. So be really mindful of your cash reserves, be really mindful of the trades that you keep open, and also look for great value plays. So just keep that in mind. But with all that being said, before we dive into the telltale signs, please consider hitting that subscribe button, ringing that bell, and smashing that like button so YouTube will notify you when I upload more videos. And also, please join us on the Patreon. It gives you access to a Discord server of over 500 investors, and it also gives you access to a weekly report of the top trades for each given week. A link is provided down below in the video description. So let's hop on over to the computer and discuss the telltale signs that the market right now is very frothy. All right, let's talk about the first sign that the market is frothy right now. The first sign is big companies are starting to split up, meaning that they are going to have more than one stock out there. For example, General Electric this week reported that they are going to split up into 3 different companies. The reason why this is a sign of market froth is because these companies know they will get more money from the public markets by splitting up and having multiple stock. For example, if we take a look at General Electric, there are going to be 3 separate public trading companies. They're going to have one for aviation, healthcare, and energy. They know that they're going to get more money by doing this because right now the market is paying a premium for publicly traded companies. Now, General Electric is a huge company, and based off of this news, we saw a 17% surge in pre-market trading off of this news. And the stock was already up more than 25% in 2021 before they even gave this spin-off announcement. And the CEO said it himself. By creating 3 industry-leading global public companies, each can benefit from greater focus, tailored capital allocation, and strategic flexibility to drive long-term growth and value for customers, investors, and employees. They know that they're going to get more capital and they're going to be able to allocate that better if they were 3 separate companies. Part of that capital is going to be coming from the stock market. And like I said, General Electric is a huge company, but they're not the only company doing this. Check this out from the Wall Street Journal. Johnson & Johnson is also going to be splitting up their business into 2 separate companies. One that's focused on pharmaceuticals and the other that is focused on medical device business. Now, the reason why I believe they're doing this is because one of their businesses is less predictable, higher risk, but greater return potentially, while their other business is very stable, it is slow growth. And that stable, slower growth company is not the kind of stocks people are looking for now. But if they're able to separate that and create one stock that is stable, low growth, and the other one that is focused on pharmaceuticals, research and development, then that stock can potentially go boom, and it doesn't have that handcuff of the Band-Aids and Tylenols that Johnson & Johnson creates. And that is because the market right now is very frothy, it is very risk on, and companies that are less predictable and have a greater potential return because of potential growth that has not been seen yet but could potentially come, all speculation, all very risky. Those kinds of stocks seem to be outperforming your slower growth, stable companies, your value companies. And that's because it's a very risk on environment for the time being. But we got two companies, two big companies, General Electric and Johnson & Johnson, that are splitting up because they're going to be getting more money from the capital markets by doing so. Now, another sign that the market is very frothy, and this is the same thing, getting money from the capital markets through initial public offerings, or what are called IPOs. The amount of IPOs this year that we have had is another sign that the market is very frothy. Companies are going public now because they know they're going to get a good valuation, and they're going to be able to get a lot of money by going public right now as opposed to going public a couple years ago. The amount of money that they're getting now is much more than if they were to go public in 2019. And that is why the number of IPOs by year in 2021 is far higher than it has ever been in this century. If we take a look back to 2000, the number of IPOs was 397. This year in 2021, it was 940. In 2020, it was 480. We almost doubled the amount of IPOs this year from last year, and that is a sign that the market is very frothy. In addition to that, we also have direct listings, and we also have companies going public via SPACs, special purpose acquisition corporations. And that is not reflected in these annual IPOs. So the amount of companies that are actually going public right now is far higher than 940. This is a sign, in my personal opinion, that the market is extremely frothy. Also, you have to consider that the more companies you have out there, the more types of stocks that are publicly traded, that is saturating the market. And that means less money could potentially go to the stocks that you own. The amount of IPOs having so many out there is not really a good thing. You don't want a bunch of crap companies going public because that's going to weigh down the entire market. Think of it kind of like the real estate market. When you start getting a couple foreclosures in your neighborhood, that's going to hurt the valuation of your home. The same thing can be said for the stock market. If you get a bunch of companies that go public, don't perform, and then have to be delisted, or they go bankrupt, then that's not going to be good for the overall market. You're going to have those crap companies weigh down on other companies as well. Now, another sign of market froth is Rivian and what happened this week with this stock. The valuation of this company right now is crazy, and everyone knows that, but the stock still goes up. The market cap for Rivian right now is 110 billion US dollars, and this company basically has no revenue. They sold under 200 vehicles this year. This is a sign of market froth, especially in a certain sector, the EV sector. Pure play EVs are having great returns, and they're at a very high valuation. Whereas other companies like Ford, who are selling more EVs and actually own part of Rivian, are trading at a market cap that is far less. Ford has 12% stake in Rivian, and the market cap of this company is $78 billion, which is far less than the market cap of Rivian. Now, the last sign that the market is frothy is the charts, the technicals. What you're looking at right now is the 3-year weekly chart. So from here to here, this is 2019. This is 2020, and from this line over is 2021, and each candle represents 1 week. Now you can see that since the pandemic, we had a nice drop. Everybody had a drop during the pandemic. Everybody knows that. Then we rebounded and we continued higher. We kept on moving up and to the right. But we're well above pre-pandemic levels. Pre-pandemic levels were around $3,400, and we're currently trading at around $4,700. The gains from pre-pandemic levels to now are massive, and they're not typical for the stock market. But the market right now is getting a bunch of money being inputted into the system, and that is why we see these kinds of gains. But based off of the technicals, it is clear what's happening. We have a channel that is up and to the right. It's a pretty well defined channel. We hit this upper trend line, we pull back a little bit, and we continue on upward. Right now, we are getting close to that upper trend line, and we could start to see a pullback. If not, we could break this and we can explode to the upside with a Santa Claus rally, but nevertheless, the market right now is frothy. We're above that upper trend line, and we haven't had a significant pullback since the pandemic. All of these minor pullbacks, they are minor. They are less than 10%. They're not even corrections. They are just small pullbacks. It is unrealistic to think that since the pandemic, or since this point right here, where we rebounded on the pandemic, since June of 2020, we have not seen a correction in the stock market. And that's because, in my personal opinion, the stock market right now is behaving in a way it hasn't behaved in a long time. We are seeing massive pullbacks in certain companies, but that money is being put somewhere else, and the major indices like the S&P 500 continue upward. For instance, when we saw a big pullback in a company like Facebook, we saw another company in the S&P 500 with a big weighting, Tesla, move higher. That pullback in Facebook was not really represented in the S&P 500 because the money just went somewhere else. And that's the kind of market we are living in right now. We are living in a market that has a lot of rotation, meaning money is being pulled out of certain stocks, certain sectors, and being put into other stocks and other sectors. And that's because there's nowhere else to put your money. You don't want to put it in the bond market because yields are so low. And right now it's still a risk-on environment. And equities, the stock market, are probably the best place to be putting your money. And that's why we're seeing these rotations. And that's why with these rotations, we're not seeing major pullbacks in the major indices like the S&P 500, the Dow Jones, and the NASDAQ. Because money's being pulled out of one stock and put into another. But with rotations, if you're an individual stock picker, some of the stocks that you might be holding might be down a lot. And as an individual stock picker with these rotations, that provides a ton of opportunity to get into stocks that are undervalued while the overall market is higher. This is one of the things I was trying to get at in the beginning of this video. Look for companies that are at good value. Look for companies that have been out of favor and money has been pulled out of. Maybe the reasons why they were being sold off is unjustified. And you can get into a company that is at good value and actually build up a position so that when the money rotates back into those stocks, you will see a nice return. But overall, the market has not had a correction in a very long time. We're approaching that upper trend line and it is looking quite frothy. Alright, mi gente, thank you so much for sticking around to the end. I really do appreciate it. Let me know in the comment section down below if you think we're going to see a pullback before the end of the year. It is my personal opinion that we will continue to see a bull run in the next 2 months. We might see a small correction, but nothing huge. I am still bullish on this market, but I am not unrealistic. I am not blind to the fact that the market right now is frothy. It's just a matter of when we will see a pullback. And if there was a pullback, I would not be scared of it. I would buy the dip because in my personal opinion, the capital markets right now are just flooded with cash. And cash is not the problem, collateral is the problem. But for now, as far as I see it, the stock markets are going to continue to rise. So I'll catch you all on the next video. Please consider hitting that subscribe button, ringing that bell, and smashing that like button, and joining the Patreon if you haven't already. Until the next video, it's been real, it's been fun, it's been real fun. And this is We Are Investing, and together we are invincible. See ya.